What if one of the most misunderstood AI opportunities in the market right now isn't about chips, GPUs, or massive language models, but about real enterprise revenue already locked in? And here's the reason this matters. If it hits $100 million to $150 million ARR, we're looking at $10 to $12 a share. That's like 170% to 200% upside. And if things really take off, $15 plus isn't crazy at all. Over the past year, outlets like CNBC and Reuters have repeatedly highlighted a shift inside the AI sector. The real value is moving away from experimental tools and toward enterprise platforms generating recurring revenue. And that's where today's setup begins. What if a company most investors scroll past has already secured tens of millions in contracted recurring revenue, partnered with multi-billion-dollar cloud leaders, and is quietly building operating leverage? That's big time, because historically, as the Financial Times has noted, that's how re-ratings begin. Not with hype, with execution, straight up. And by the end of this video, you'll understand why a growing group of long-term, data-driven investors are starting to pay attention, and why this stock could look very different. Here's why this matters right now. The goal today is to break down a high-growth AI company, strictly through a financial and valuation lens. No speculation, no chart theatrics. Keep it 100, just revenue visibility, recurring contracts, balance sheet positioning, and valuation math. The same framework used by institutional desks at firms regularly quoted by Bloomberg and Reuters. Before we jump in, welcome to KMI, delivering sharp, data-driven insights on emerging tech and high-potential U.S. market opportunities, designed to help you spot the next big winner. So now, let's talk about the company. The stock is Rezolve AI. It trades on the NASDAQ under the ticker RZLV, operates in AI-driven commerce, focusing on real-time personalization, customer engagement, and intelligent checkout systems for large retailers. This is not consumer AI. This is enterprise software, top tier. Rezolve builds what it calls the Brain Suite, a proprietary AI platform designed specifically for commerce workflows. The goal is simple: increase conversion, improve personalization, and drive measurable revenue outcomes for retailers. This places Rezolve in the same commercial ecosystem as much larger, multi-billion-dollar platforms like Adobe Commerce, Salesforce Commerce Cloud, Shopify Plus, and Oracle NetSuite. Companies CNBC and Bloomberg routinely reference when discussing AI monetization inside global retail infrastructure. It also puts Rezolve in close proximity to hyperscale partners like Microsoft, Google, and Amazon Web Services, which dominate enterprise cloud distribution, main plug energy. Now let's talk money. On a trailing 12-month basis, Rezolve AI has reported roughly $5 million in recognized revenue, as reflected across Yahoo Finance and NASDAQ filings. Yes, that number is still small, but that is not the number long-term investors are focused on. The key metric here is annual recurring revenue, or ARR, a metric Bloomberg, FactSet, and Seeking Alpha consistently emphasize when valuing enterprise software companies like ServiceNow, Snowflake, and HubSpot. Rezolve has publicly stated it has already reached approximately $70 million in ARR, not projected revenue, not pipeline estimates, contracted recurring revenue. That's the real deal. Management has further guided that ARR is expected to exceed $100 million by the end of 2025, a projection discussed across NASDAQ.com and institutional research platforms. That is a meaningful inflection point. This is where it gets lit. In software, ARR often matters more than current GAAP revenue because it reflects future cash generation, a point Motley Fool and Bloomberg have reinforced repeatedly in coverage of enterprise SaaS leaders. According to data tracked across Bloomberg, The market is currently assigning this company a valuation of roughly $1 billion. But as Bloomberg often emphasizes when covering enterprise software, surface-level valuation rarely tells the full story in early monetization phases. And that disconnect is exactly where asymmetric opportunities are created. At $70 million in ARR and a roughly $1 billion market cap, Rezolve trades at approximately 15 times to 17 times ARR. For context, many AI software peers operating alongside Microsoft Azure, Google Cloud, and AWS trade anywhere from 35 times to over 100 times ARR, once growth visibility improves. That valuation gap is the core of the bullish thesis. That's a crazy gap. What if one of the most misunderstood AI opportunities in the market right now isn't about chips, GPUs, or massive language models, but about real enterprise revenue already locked in? And here's the reason this matters. If it hits $100 million to $150 million ARR, we're looking at $10 to $12 a share. That's like 170% to 200% upside. And if things really take off, $15 plus isn't crazy at all. Now let's talk about catalysts. Because catalysts are what move stocks from narratives to re-ratings. This is the part that goes wild. The first and most important catalyst is ARR, growth itself. Moving from $70 million in ARR to over $100 million represents more than 40% growth in a short period. If Rezolve executes on that target, the valuation math changes quickly. A stock trading at 15 times ARR today can re-rate to 20 times ARR simply by proving consistency. That alone implies meaningful upside, without heroic assumptions. Before we move on to the second catalyst, if you're enjoying this breakdown, I'd really appreciate it if you could subscribe. A quick subscribe would honestly mean a lot. Now, let's move on. The second catalyst is enterprise contract expansion. Rezolve has already announced large commercial contracts, including a reported multi-million-dollar agreement with Liverpool, one of the largest retailers in Mexico, a deal highlighted in NASDAQ-linked coverage. Large enterprise clients reduce churn risk, they increase revenue visibility, and they create reference customers that unlock additional deals, something CNBC and Bloomberg frequently cite when discussing SaaS valuation expansion. The third catalyst is strategic distribution. Rezolve has integrated with Microsoft Azure and joined the Google Cloud Marketplace. These are multi-hundred-billion-dollar ecosystems. This mirrors distribution strategies used by Salesforce, Adobe, and ServiceNow during their early scaling phases. If even a fraction of Azure or Google Cloud Enterprise customers adopt Rezolve's platform, the revenue impact could be substantial. To put numbers around it, 100 enterprise customers paying an average of $500,000 annually would add $50 million in ARR. That's a monster move. The fourth catalyst is institutional validation. Reported institutional ownership includes major asset managers and hedge funds. Data tracked across Bloomberg, FactSet, and Yahoo Finance. When institutions increase exposure, liquidity improves, and valuation compression often follows. That's legit. The fifth catalyst is operating leverage. Market analysts following the stock on Seeking Alpha suggest Rezolve could approach profitability in 2026 if ARR continues scaling as guided. Profitability changes investor perception. It moves the company from speculative growth to scalable business. Now let's anchor expectations with price targets and probabilities. In a conservative scenario, where ARR reaches $100 million and valuation multiples remain near current levels, fair value estimates land in the $7 to $8 range over the next 6 to 12 months. That represents roughly 90% to 100% upside from recent trading levels. In a base case scenario, where ARR reaches $125 million to $150 million, and the multiple expands modestly to 18 times to 20 times ARR, price targets move into the $10 to $12 range. That implies roughly 170% to over 200% upside. In a bullish scenario, where ARR exceeds $200 million and the market applies peer-level multiples near 25 times ARR, levels often seen in high-growth AI software discussed by Bloomberg and CNBC. Valuations support prices north of $15 per share. That outcome is not guaranteed, but it is mathematically plausible if execution continues. This is how valuation expansion works. Market cap follows revenue, revenue follows contracts, and contracts follow adoption. Right now, Rezolve sits early in that curve. This is the start of a potential run-up. Of course, there are risks. Execution risk is real. ARR targets must be met. Cash burn remains a factor until scale improves. Competition from players like Shopify, Adobe, Salesforce, and Oracle is intense, and market volatility can punish high-growth names quickly. It can get volatile, but those risks must be weighed against the probability-weighted upside created by recurring revenue growth and institutional backing. The same framework used by professional analysts across Reuters, Bloomberg, and the Financial Times. So let's recap. Rezolve achieved approximately $70 million in annual recurring revenue, with guidance to exceed $100 million. The company is backed by institutional capital, strategic partnerships with Microsoft and Google, and expanding enterprise contracts. Valuation multiples remain below many AI peers, despite improving fundamentals, and upside scenarios range from moderate to substantial, depending on execution. If an AI company can deliver real recurring revenue, enterprise adoption, and operating leverage, should it still be valued like a speculative concept? That's the question investors need to ask themselves. If this breakdown helped you think more clearly, hit the like button, subscribe to the channel, and let me know in the comments what ARR milestone would change your conviction most: $100 million, $150 million, or $200 million. I'll see you in the next deep dive.